Welcome, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio, the most important hour of radio every Monday on 15 a.m., The Big Talker. Thank you for joining me this afternoon. For those of you who don't know, Real Estate Radio is a show dedicated to building the Washington, D.C. Metro's housing and credit markets one home at a time. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted advice. That's my message, and I will be delivering it to you guys every Monday from 2 to 3 p.m. right here on 1580 a.m., The Big Talker. We've got some great stuff lined up. We've got, joining me on our panel today is Louis Cammarosano, who's the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you what happened in the markets last week, as well as letting you know what is on deck for this week that will affect you and your real estate decisions. Louis, you there?
I'm here, Ryan. How are you today?
I'm doing well. Did you have a great Father's Day?
I did. I got some nice handmade presents from the boys.
That's awesome. Yeah, it was my first Father's Day as well.
Right?
Yeah, first one, so it was great. You know, it was a pretty relaxing weekend. Actually, I was telling Sam here in studio that, you know, Thursday I actually went to the U.S. Open, which is an awesome experience at Congressional Country Club, which is, believe it or not, it's supposedly the largest country club in the United States. And when you go to this thing, I mean, it looks like, this huge villa in, like, Italy or something like that is what it really looks like from the outside. So that was a great experience. And then, spent pretty much the remainder of the weekend just kind of resting up and hanging out with the boy. So it was a good time. But we've got a lot of stuff on tap this week. And first thing, interesting article that I wanted to hop into first was that the heiress Petra Ecclestone, who's the daughter of Formula One boss Bernie Ecclestone, bought the U.S.'s most expensive home in L.A. that was formerly owned by Aaron and Candy Spelling. Now, obviously, most people know Spelling from 90210, Charlie's Angels, a couple of the other hits that he had along them. He died in 2006 and made his name as a producer of the shows that I just mentioned. And I guess his daughter, Tori, who was in 90210, lived up there until the time she was 19. This house, the asking price for the 14-bedroom residence, which included a bowling alley, a beauty salon, a gift wrapping room, and parking for up to 100 cars, was reported at $150 million. Now, the final sales price on this actual house, I guess, wasn't really disclosed, but it was probably rumored to be less, somewhere a little bit lower than $150 million. But a 57,000 square foot house, isn't it amazing, Louis? I mean, it's spectacular when you look at the pictures of the outside of it.
That's not a house. That's a shopping mall.
That is true. Because it was somewhere in the article, I believe they what was it? Let's see. He once quipped of the house big. I'm still trying to find the bathroom. So I think that tells you all we need to know about that house. But I just thought it was interesting to note because it was obviously, touted as the U.S.'s most expensive home. Big news that I want to kind of jump up and start because it's been hitting the headlines this morning is what is still taking place over in Greece. They were supposedly working out something to give them another loan to basically not default on their debt. Basically, they've now delayed this. They want a lot more clarification from the actual, government over there for what their plans are, to do, what they're going to do with this money. And, I really want to, let listeners know and kind of digest what is going on over there because I think that, what's taking place over there right now is something similar to what we could see happen in the United States in the next year or two. I'm very uncomfortable about the fact that, like a lot of this burden is coming back for the people of Greece that are now in the streets basically protesting. A lot of them are people that have retired at younger ages. I believe Greece's, retirement ages is a lot, I want to say it's early 50s compared to here. But what the government is now doing is now they're cutting benefits for these people that have retired. I was hearing on average like somebody that was getting like $2,200 in medical benefits is now only going to be getting $1,700. So instead of the banks, the big banks and the people that have this debt, instead of them taking and having to write down some losses, they're putting all the burden on the people.
Yeah, they're going to make them retire, wait till 28.
Yeah, that's
to retire too.
Yeah, exactly. Well,
what you're saying there, Ryan, is correct, that somehow in a normal free market, the bondholder is the one who took on those bond obligations, who agreed with the Greek government
yes.
at a certain interest rate that's what they would be paid, knowing the risk, and now somehow there's an argument that they shouldn't have to take what's called a haircut.
Yeah, exactly. But the interesting thing is, Lewis, that you and I have discussed this a lot. Is that this is similar type of thing. What's going on in the U.S. right now?
Well, what's going on in the U.S. and in Europe is similar. And in both the European Central Bank and the Federal Reserve, instead of allowing the sovereign states of Europe to default, or the Fed allowing any United States debt to default, they won't allow that. They'll print the difference.
Exactly.
Which in a sense is a tax, because that just creates more inflation. It seems that's where Greece is headed, that the European Bank will eventually do that. What they're trying to do is force both the government of Greece to pay, in a sense, by putting in these austerity budgets, and then they're trying to get the bondholders to agree to some kind of voluntary
delay in payment,
delay or some restructuring of the debt. But eventually, something's going to crack, and when it cracks, it won't just crack and the chips will fall where they may. The European Central Bank will do the bailout. And what I didn't understand also is the exposure of the banks to the Greek debt. A lot of them are the ones who have it, so it's not like we're saying the bondholders should know better and they should have to take their losses. The bondholders, many of them are the government entities in Europe and probably even in the United States.
Right.
And then that has an impact on commercial paper that they may hold and so on. So it will have a ripple effect. You say it's a small country, but it's tens of billions of dollars.
Yeah, well, and then they're worried, also, you have basically Italy and Spain that are right there, that the contagion will spread. And which, obviously, what you just said, it makes sense. That it will most likely happen. Because
they're just trying to probably reduce the size of the bailout by forcing some austerity measures and then forcing some haircut on the bondholders. But really, it's the same with the United States. There's no way that it can be paid back without a bailout, because the United States can never pay back its $14.2 trillion.
Yeah.
So there will be not necessarily a formal default, but there will be a print default, meaning that the monies will be paid back, but they'll be paid back in excessive overprinted dollars.
Right. I mean, they're going to have to devalue the currency, obviously. You know what I mean? Most of the time, that's what a lot of countries, elect to do. Devalue it as much as possible, which seems to be the course the United States is on as well. I mean, you sent me that article last week, which was interesting, from PIMCO founder, was it Bill Gross? And I thought it was a very interesting little tidbit from him being on CNBC, where he said, okay, most people focus on the nation's public debt, which is $14.3 trillion, but that doesn't include the money that's guaranteed for Medicare, Medicaid, Social Security, which comes close to $50 trillion. According to government figures. Then he takes it a step further in saying that also the debts from the programs related to the bailout of the financial system following the crisis of 2008 and 2009 could put the total near $100 trillion. So we don't even really have an accurate number of where our actual debt is.
And then also there's a derivatives against all of that debt that multiplies it by 10, 20, 30-fold. And basically, that's more money that's ever been produced by the GDP of all the countries combined in the world.
Yeah, absolutely. And I mean, this is the thing where, when you and I look at this and we kind of look, and consumer sentiment's been falling month after month. I'm sure you've been following that as well. And when we keep hearing this, the same talk month after month, the Fed keeps saying the same thing, which we know that there is another Fed meeting coming up this week, which I believe it's going to end on Wednesday, where Bernanke will have another press conference afterwards like he did the last one. I think it's kind of interesting how this is, now I guess going to become more of a regular occurrence with him. But, the same talk month after month. I mean, and we wonder why things are not getting better, sentiment's not getting better, because we're just doing the same exact thing month over month.
Well, what they've said, which is interesting, is that they want to keep interest rates low for a foreseeable period of time, not a foreseeable period, but for a long period of time in the future. The problem they're going to have is they're working against the market. The market is demanding higher rates. They're either going to have to fix the rates at a specific rate and say this is what we pay, and then, of course, if no one buys it, then they're going to have to buy the bonds, which means they'll have to print up more money to do so. And it's funny because what they're trying to do is keep themselves at this. The Fed actually has, I don't know if people know this, a target inflation rate, which I think is kind of ironic. That's like saying we should have a target pollution rate. We want to make sure we have just the right amount of lead in our drinking water. Inflation, we shouldn't have any inflation. We should probably be striving to keep prices down. But they have that wiggle room in the official inflation rate so they can print money.
Right.
And right now, they can claim that the inflation rate is below their target rate. So therefore, if things are not going the way they've anticipated, and they never get it right, they're going to have an excuse to have to go ahead and go back to the printing presses.
You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano, the general manager of Home Game. Louis, interesting. I found some news data from the Fed that was just released. It showed that deposits at U.S. banks exceeded loans, reaching a record of $1.45 trillion last month. Now, back in 2008, loans exceeded deposits. In the 10 years before credit markets seized up in 2008, U.S. deposits exceeded loans by an average of about $100 billion. This is from data shown by the Fed. As deposits, this is my feeling anyway, as deposits exceed loan demand, banks will buy more treasuries, thus keeping interest rates low and likely to maybe allow interest rates to stay lower now. So I think it is interesting now that this is like one of the first times that we've had this happen in a long time, that banks have obviously been sitting on their money for so long that we finally got these deposits that are now exceeding the loans that they're lending out. They're going to have maybe more money to start throwing at these treasuries. And, who's to say? I mean, I could kind of see this happening because obviously if the Fed's helping these banks, the banks are going to turn around and help the Fed. Do you agree?
I agree 100%. Everyone that's in the game, all the sovereign entities, all the banks have a vested interest in keeping interest rates low. Because as you mentioned, high rates and inflation are the enemy not only of people who want to take mortgages out in the real estate market, but they're also the enemy of the banks.
Yeah.
So they will do whatever they can to keep these rates low.
Yeah, and then, we had brought up last week that we said, the private investor or private lender that's out there would need at least probably anywhere from a 2 to 3% spread more than what the current market is bearing. So we know that they're not jumping into the market anytime soon. And there's an article here from the Associated Press that fixed mortgage rates have dropped for the 8th straight week.
It's incredible.
It is incredible, isn't it? It's just like just when you think that it can't go any further, it does. And I mean, it's great for you, the home buyer out there, for you, the first-time home buyer or seller that's looking to get out of your, the home you're in and move up. I mean, I can't stress this enough. I know I seem like a broken record here by saying, that now is a great time. I mean, especially in the Washington, D.C. metro area, because we've actually seen an appreciation occur over the last 6 months to a year, and that is likely to continue as long as interest rates stay low. So it's a great time to sell your home, and it's a great time to buy a home because the average from the Associated Press mortgage rates on a 30-year fix were 4.49 for the end of last week on a 30-year fix, and on a 15-year it was 3.68%.
But Ryan, when there's something wrong nationally, let's put aside the DC Metro. When interest rates are this low and yet home prices continue to decline, could you imagine how low prices of homes would go if the interest rates are more at a natural level and not one based on the Fed and government intervention trying to boost up the housing market?
Yeah, Louis, I'm glad you brought that up because that leads me to another thing that I was thinking about over the weekend is, we were talking about the rest of the country and why housing isn't picking up. And obviously the lending, the guidelines are tightening up tremendously. Okay. Mm-hmm. And I was remembering back during the time where we had this great boom going on. And one of the key things that I remember during that time was that, let's say that you were in your current home right now, Louis, and you wanted to take and rent your home out and go and buy another one. One of the lenient guidelines that were there was that as long as you got a lease signed by a new potential renter, we didn't have to count your old payment against you. We could take basically a percentage, 75% of that rental income, and back that out from your mortgage payment. You could then turn around and go buy another house and not have to count that payment against you. And the reason why I think that's so important right now is because how many people are stuck in a situation where they owe more money on their house than, do you see what I'm saying? Mm-hmm. So if that was that was a huge driver. I can't even remember how many loans I did during a certain period that people were renting their house out and they were going and buying another property. And when they did that, it was like, okay, I don't have to count this payment at all. So it looks like I qualify fully, even though this, you don't show anything as far as, your ability to repay as a landlord. Now the restrictions are you have to have that rental property on your tax returns for at least 1 year in order to count that rental income.
That doesn't help. And also back in the period of time you're talking about, the supply was limited. And right now the supply is abundant. So your supply-demand issues are entering into play, keeping the prices down.
Right. So we have that, so you have that issue. And then the other issue is that for the people that did take out low down payment loans such as FHA, which is a 3.5% down payment, and now they're upside down in their house. Once you take out one FHA loan, you can't just go get another one. So those people are stuck in their house with that loan until they can find a way to either come up with the difference and pay it off, or they have to, just basically sit around and wait until they get to an equity position that allows them to sell their home.
Right. So right now you have lending restrictions, you have unemployment issues, and you have oversupply, which is a stark contrast to what you had 5-6 years ago.
Yep.
The only thing that's keeping it from being worse is in the D.C. metro area, you have a robust job market, and then, of course, keeping the interest rates low. And then last year or 2 years ago when they had the interest, they had the first-time homebuyer credit.
Yeah,
once that went away, then the bottom fell out again.
I know another interesting thing. I can't remember where I saw it, but it was something with the foreign buyers buying U.S. housing. I want to say this was a number that came out. It was something like $41 billion was spent by foreign buyers on U.S. housing, which is a huge number.
Well, the dollar is lower, so their currency goes further, and they're cash buyers, many of them.
Exactly. So we have a lot more of that going on. So, and that kind of, all this goes back to basically every 1 in 4 homeowners are underwater. So that eliminates, over 25% of the people that are out there that could potentially buy. Then you have people that don't have jobs. So that eliminates them because you got to have basically a 2-year consistent history. Employment to get a loan. So just imagine all the people that are going through unemployment right now or have been for the last 2 years. That's going to rule them out until they can get a steady stream of income coming back in. So that's going to rule them out. Then we have the people that are wanting to rent their home and move to another house, and they can't buy because they can't do anything with their property.
Right, and let's add to that the general market psychology of people who may want to buy a house but are a little cautious based on the experiences that they've seen of their friends and relatives who've been foreclosed on. And then there's the rent-to-buy ratio, which I think has received much more attention. In some areas, it's cheaper to rent than it is to buy, not in all areas. But, that's another disincentive for people when they see that.
Yeah, absolutely. Just a quick note, last week, mortgage applications were up. They did surge quite a bit, and that's basically just because of the falling rates. It looks like...
Is that mostly refi, Ryan?
Yeah, it has to be honest with you, because the numbers don't tend to spike that fast in a week because of, your purchase transactions are going to take 30 to 60 days.
Right.
And it has to be mortgage, for refinances. I know that I've had personally 3 or 4 people that I've been talking to within the last 2 weeks that are all like, it's making sense for them to consider refinancing from a 30-year fix to maybe a 20 or a 15 and cut off, a lot of that time period there and keep
or cut off a point or two.
Or cut off a point or two. And I mean, really, at the numbers that we're at now, it makes complete sense. A lot of those people were kind of on the fringe with as far as what their loan to value was or how much equity they had in their home. And within, from the last year or so, we've gotten a little bump that's now put them in a category where they might not be at an 80% loan to value. For all of you out there, that when you're at 80% loan to value, that allows you to not have mortgage insurance, which is a big prohibitor, and most people want to refinance because if their home value has been declining, typically their loan to value is going to be higher than 80%. So these people have now gotten back in the game where they're maybe at like 85%. But what we're able to do with those clients, Lewis, is we're able to do what's called lender-paid mortgage insurance, where you finance that amount above the 80% into the rate, which you can then eliminate the mortgage insurance. Okay, so it may not. And I'm just going to throw out broad numbers here, but let's say that the average on a regular 30-year fix with perfect credit scores at an 80% loan to value, let's just say it's 4.5%, and let's say you have another client that has everything perfect on credit scores and all that, but they're at 90% loan to value. Well, they would typically have mortgage insurance, but you have an option which is called lender paid mortgage insurance, where you can basically raise the rate up and finance that mortgage insurance into the loan. Now, instead of 4.5, it might be 4.875. Still a great rate, right? And it makes complete sense to do because you're able to just take and finance that mortgage insurance in, still get the lower rate, and lock yourself in at an interest rate that probably after the next year or two of these lows that we're having we might not see for quite some time.
Ryan, you're highlighting again, and everything you just took me through. You didn't need to make any of these considerations a few years ago.
No.
You didn't really need a trusted real estate advisor, trusted mortgage professional. You just needed to go and get yourself a loan, present your documentation, if any, and buy the house.
Yep.
And then and wait for it to go up.
Yeah, and now you're really having to get resourceful and really find out all the options that are out there.
Right.
And that is a critical component. I mean, especially like if you're let's say that you're a real estate investor and you're trying to go out there and you're trying to buy as many properties as you can. A lot of lenders have guidelines and restrictions for how many investment properties you can have they might not give you a loan if you own more than 5. So you really need to know and be setting up your portfolio correctly, as not only, having a good CPA and good tax accountant and all that, but you need to be working with a mortgage professional that knows how to set up your loans properly to where you're going to be able to, count the rental incomes so you go moving forward so you can qualify for more loans. I mean, I can't tell you how many novice investors, Lewis, that forget to, or I don't know if they forget, they just don't put the stuff on their tax returns. And it prohibits them from buying another investment property down the road.
Yeah, well, they're good investors, but they don't know the ins and outs of the real estate industry.
Yeah, and back when, remember, you could be anybody, and you could just go out there and put a contract on something and get a loan, which didn't require you to do much. And that was a prime example for investment properties. At one point, I remember there being a loan, I want to say it was a no-doc loan on an investment property, so you didn't have to provide any documentation for your income, your assets, anything, and as long as you had over a 720 credit score and you were putting 5% down. Now, it's the most absurd loan I've ever heard. I mean, I wouldn't lend my money on that.
Yeah, but they were all guaranteed loans, so
yeah,
the lender really wasn't lending the money. The government was guaranteeing it, so in effect they were backstopping it.
Yeah, and I think what I'm kind of getting at is it's kind of like, we go from one extreme to the other, though.
Right.
You know what I mean? And now we've gotten to the point where we have, I can't tell you how many countless good buyers I have that I can't get into loans because there's just some little tiny caveat in the guidelines that are going to make it so that they can't get into a home. With just the reserve requirements and then the ratios, if it goes like, 0.1 over, but they have like a part-time job, but since they've only been there for a year and a half and not quite the 2 years, they can't count the income.
Well, if you look at it, Ryan, it's because the government set non-market standard rates that were too loose a while back, and now they're setting non-market standard rates that are too tight.
Exactly.
Really, if you just allow the market to determine what people would lend at what price, then everything would work itself out. But the government has no way of knowing what the market should be, and yet they try to inject themselves into it because they've got a broader policy. Before it was trying to get as many people into homes as possible, so they created incentives for people to get loans that the market otherwise wouldn't give them. And now they're trying to cover their track and keep home prices up, and they're trying to avoid further losses, so they're putting in more draconian non-market type of restrictions on loans.
Yeah, I agree with you 100%. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano. Number is 877-245-2030. That's 877-245-2030. Louis, I think it's interesting because, what you keep saying, free market. I mean, really, that is what we need. Instead of having to talk about, what's going on with the Fed and the manipulation of our dollar and everything else. I mean, really, if you've got willing and able buyers out there, you need to have some guidelines, but they need to be somewhat realistic at the same time.
Well, the problem is that the government is so involved in the housing market, has such a vested interest in it, that's not going to happen.
Well, it will happen, but just not soon enough. You know what I mean?
Right.
Like, eventually it's going to go so far that they're going to be like, well, how come people aren't buying houses anymore? And then they're going to have to completely loosen up.
Right, but then you realize that a planned economy doesn't work.
Yeah, I know.
The way natural markets would work would be you'd have less of a boom, and therefore you'd have less of a bust. And what happens is they create the boom by having all these loose standards and easy money, and then they try to avoid the bust by doing what they're doing now. So if you had a freer economy, people would buy and sell homes at the natural rate at which the market demanded.
Yeah, I agree 100%. We're coming up on a break, Lewis. When we come back, why don't we go ahead and jump into your 2011 second quarter home prices survey? Stay right there. Thank you for listening to Real Estate Radio.